Dear clients, welcome to Phillip Securities Research Weekly Market Update. On the 5th of April, morning notes, we advised clients to take some profit. This is because the onus is now on macroeconomic and earnings data to outperform, as policy safety nets of QE3, which hedged the economic downside, was perceived by the market to be removed, as the latest Fed meeting detected a much less dovish committee outlook. Simultaneously, macro risk from Spain is rising, bond investors selling Spanish debt, pushing the yields close to 6%, only 100 basis points from the critical 7% mark. Spain is caught in a negative feedback loop of austerity begetting recession, begetting more austerity. It badly needs some growth, but structural reform will take time. It is quite likely that we will need some sort of ECB intervention again. It is still possible for this correction to be merely interim and for markets to make another push higher, although this will depend heavily on policy safety nets coming back to the fore, which is possible given the economic downside risk that we are facing. Possible interventions could be a revival of QE3. Asian central banks could have more room to loosen if weak growth brings down inflation. China could still make a big policy move given the increased hard landing risks, and as we said, we do need the ECB to backstop Spanish bond yields. Looking further out, fourth quarter of 2012 this year could be challenging again, as 2013 is going to see large-scale fiscal withdrawals from the West. As such, our regional strategy reports are currently overweight on markets which have stronger domestic stories to mitigate this risk, like Indonesia and Thailand. In Singapore, we are sticking with high-yielding cash-distributing names underpinned by resilient business models, like SATS and Sembcorp Industries. Thank you for watching, and tune in next week for Phillip Securities Research Weekly Market Update.